Guys, we're gonna start. We're past the hour, but we were kind of like giving some more people time to jump on. They'll just have to like catch up. And most of you know Debbie, so we're glad to have her back in the office. A lot of you participated in her trainings on Zoom. Lynn and I were actually on one of her trainings for the elite team last week. That was kind of fun.
I missed it.
Yeah.
We have the YouTube link if you want it.
Okay. Yeah, I can do it. That was a lot of fun. So we got a 2-hour CE class today. Pre-approval process. I like this topic because it's where everything starts. And I tell people all the time, hey, my kids all bought houses by the time they were 22 years old because we just started with this. And that's where all the education starts too, right? Once you start the application, then you talk to Debbie and she goes over loan options and your unique circumstances. So there's a lot to really soak in here that we can talk to our clients about and for us personally. So Debbie can take it away. I'm going to share your slide deck and give you got your clicker, is it on? On the side. Yep. Nope. There we go. You okay? You're up. Go ahead.
Thank you for coming. Thought you were registered, so well, Jeff told me you were. Yeah, welcome. So pre-approvals kind of necessary in this whole fun real estate game, unless you're a cash buyer. But other than that, everyone has to kind of get that done. I love that Jeff covered how we customize that, right? So sometimes when people just go to their bank or their credit union, they're just kind of slid, hey, this is what you do. You're in this box or you're not in this box. But if you go to an independent mortgage loan officer, they have typically a whole lot more options for your buyers and can really customize what they're doing for them with this whole interview process, just like you guys do when you guys are talking to them about what are your goals in homeownership, what are your likes, what are your dislikes, what are your must-haves. We're doing the same thing in the lending process to customize the loan options for them. So I'm going to cover a lot of that today, and you will get credit for coming. All you have to do is fill out the form at the end. I can see everybody's faces and names, and so there's not going to be keywords today because I'm the worst at doing that when I'm not co-teaching. So no keywords today.
My job there.
If you want keywords, will help. But I didn't even put that in the form today. So there's just going to be a QR code at the end with the standard info that we need to bank your hours, and then that'll be done either by today or tomorrow for you. Pre-approval 101. So this is just going to be very basic info. Probably most of you guys know this already, but if there's anything that you don't, let's stop, let's have questions, let's share stories. Maybe something that you learned along the way by someone who didn't have a good pre-approval done and why it's important. I have a few of those stories myself. In just the last 2 months, I've gotten 6 rescue deals from people who were under contract and thought they were pre-approved, but it wasn't a real pre-approval, and so things were crashing, and we saved all but one of them. So but I'll go into those stories and those details later, but like that's why. Well, they got halfway through the process and then told they can't do it. And your main job as the loan officer, there's a whole team, as you guys know, there's processors, underwriters, transaction managers that go into this. But your loan officer's #1 job up front is to know those guidelines and those regulations and to ask the right questions so that those problems don't come up later. Now, occasionally they do, no matter how good, you could work with someone who's been in the business 20, 30 years, and some of those things still come up. But a really good one is constantly studying regulations and guidelines and qualifications daily as part of their job so that those things don't happen. So we'll go over what all of those are, the questions you need to ask your lender to make sure that they've done these things if you're a listing agent, and all of those fun details. That's me. Let's see some mortgage. All right, so the very #1, if you need to get a mortgage, you're not paying cash for your property, is credit. Why would that be, James?
How else are you going to pay for it if you don't necessarily understand your own credit and have a good history?
I mean, if they can show income, why does a lender need to know about their credit history?
Yeah, exactly. It shows how they manage their debt they've current or had previous, it's gonna be an indicator how they pay their bills moving
It's
forward.
an indicator of how they pay their bills. So I have had buyers, my very first loan, she made just under $1 million a year herself. And yet had not made all of her payments on time. Because sometimes when people make a ton of money, they just think they don't really need to worry about it. I've actually seen that a few times with, well over 6-figure earners, and they have a missed payment or two and they don't worry about it. But it affects the credit score. And if someone is going to hand you $700,000 or more, somewhere in $400,000, $900,000, they want to know that you are going to pay them back, whether you can afford to or not. That is what the credit report is showing us. And there are a lot of things that we're going to be talking to the buyers about credit specifically. It's not just, hey, your score is 400, sorry. It's here's why it is. And here's what you can do about it. We're going to educate people because they weren't taught this in high school, right? Did anybody here have a credit class in high school?
No.
Yeah, me either, which is a huge disservice because it affects your entire financial future, right? Your ability to buy a car and get to those jobs, or your ability to buy a home, which is the biggest deal that is people are held back by when they don't understand credit in high school. So we do want them to learn as young as possible. And there are some things we can do to get those credit scores up. Say for young people, one of the things mom and dad can do is add your teenagers to one or two of your trade lines. And then they start building a score, and then they can buy a home when they're in their early 20s and don't have to go to the bank and suddenly find out, hey, I've never, had a bad payment. Why do I not have a credit score? Or why is my score so low? Well, they just don't have any history, right? There's a lot of things that go into credit. So number one thing that your lender is going to be looking for is making sure they make those payments. And we see things like oopsies, where there's somebody has an auto pay of $10 that they just forgot about, and they get a 30, 60, 90-day late score on there. It's dinging their score. Those are not things that we can fix very easily. So teaching your buyers to be really on top, pull a annual credit report from annualcreditreport.com and being on top of those payments, making sure you know about all of those things. But one of the things, if we see the low score and it's just high balances, this is what investors deal with a lot. They get a business card and they put everything on the business card because they're building their business credit. So they'll have 95% capacity on this one card, but they've got 4 or 5 others that are, have nothing on it. Well, that actually destroys your credit score. So we can talk with them about how to, at least, during the pre-approval process, and to diversify those funds among the cards. So the sweet spot to build your score is anywhere from 10 to 30% is what the bureaus like to see in their algorithms that will keep your score the highest, is keeping it under 30%, but not 0. Because if those cards are at 0, then you're not using the portion of the credit called credit usage. So they don't, and then you don't want to be paying off cards too. This is something you want to educate your buyers on as soon as possible, or get them into your lender to educate them as soon as possible, as not paying off your cars and not paying off your car loans until you've talked to your lender to see what that will do to your score. So we're looking at, credit scores, and we're balancing debt to income ratios, and it's kind of like financial forensics, all the things that we have to do to make these files work when someone is just at capacity in 1 or 2 of these areas. So if they have a decent debt to income ratio, but the score is low, we wouldn't want them to pay off those cards, even though they think, oh, that would lower my debt to income ratio, so I should qualify for more. But if it drops their score below the qualifying amount, then all of a sudden they don't qualify. And these are just the things, the ins and outs, that's your loan officer's job to know and to educate your buyers on. So I always recommend getting them in sooner rather than later, even up to a year ahead of time. If you are working with a good loan officer, they should be happy, willing, and able to have those conversations about educating them and doing consistent homebuyer classes and consistent investor classes so that your buyers understand these things, whether they're 18 or 80. I have even worked with a 65-year-old who didn't even know what Experian was.
Wow.
Yeah, shocking, right?
Experience.
So yeah, there's multiple credit bureaus, TransUnion, Experian, Equifax, and mortgage, Fannie Mae and Freddie Mac guidelines do require we pull from all three, a tri-bureau report. So that's gonna be, what we're looking at the credit. FICO scores are gonna be different. What your lender pulls, there's multiple FICO scores, and your lender is going to be pulling the mortgage score, which is vastly different also from Credit Karma. Who has heard of Credit Karma? And in our world, that is akin to Zillow in your
It's a rough estimate.
estimate based on what's called a soft pull. And so that is the same thing. Like when you get those letters in the mail offering you, say you've been pre-approved for this trade line, but then you still have to apply, and then you may or may not actually be pre-approved. So they get, they can pay $5 instead of the full 35 and get what's called a soft pull and get a general idea of the basic information that they're legally allowed to share and offer those. And we can do soft pulls too. And I do that with some, when I work with developers and we've got like letters of intent or things like that, or for people who are doing seller financing right now, but in 2 to 5 years, they're going to need to refi. We can do soft pulls and work with people in those kinds of situations. But to get your actual mortgage right now, we have to do the tri-bureau report, and it can be, we've seen it up to 50 to even 80 points different than Credit Karma. So that's something that you guys can share with your buyers as well. Or of course, your loan officer can have that conversation with them for you. But that's something if, just having these nuggets in your mind, you can start to hear phrases that they might say. They might say, well, Credit Karma says I'm at this thing, so I should get the best rate. And that's something you can say, well, Credit Karma could be a little bit off, just like a Zillow's estimate, right? And that's something your lender's going to need to look at.
Does it usually err low or high, or can it be both?
Both.
So some people might not think they can go get a loan because they've heard what the minimum score is or whatever, and Credit Karma's telling them to keep up.
Yes.
So
Yes, thank you. So that's a good talking point for your buyer is if they think their score is too low based on Credit Karma, the only way to really know is to talk to the lender and actually find out.
Yeah, I've had it go that way. So I use Credit Karma to find out like if I get a rough idea of where I'm in and all that fun stuff, right? And then it's usually been low, but when I've gone in with Corey, sometimes it'll be like 10 points higher. It's like, what? Yes.
Yeah, and that's
It's always
higher than when the lender pulls it and it's higher than Credit Karma said, but it can be lower. So yeah, that's a really good point to have that conversation with them either way. If someone has the desire to buy a home, it is our job to educate them on how, no matter what the resistance is they have, well, my score's too low, or I don't have a down payment, or the market. It is our job to cultivate the answers and the solutions to any one of those, which is why we have these classes, right? Okay, so credit. The one and big thing you must know. So missed payments is not something we can fix, but it is something we can work with if it hasn't affected their score too much, unless it was a missed mortgage payment within the last 12 months. They will not qualify for a new mortgage if they've missed a mortgage payment in the last 12 months. So that is something they will have to wait it out. But again, doesn't mean we can't stay in touch, both the agent and the lender team, and continuously support, educate, remind them of auto pay options and things like that might assist in preventing that from happening in the future. Okay, so what is collateral, Ian?
Actually, I've got a question.
Yeah.
You said unless it's missed mortgage payments, what about HELOCs?
Okay, yep.
Okay,
That's a mortgage, it's a second lien. Yeah, don't miss those. Please put them on auto pay. If you want to pay extra, it's really easy to do, but always put your mortgages and HELOCs on auto pay.
Something I found out for myself working with some really horrible property management companies. They wanted to take responsibility for the mortgages and pay them. But yeah, they messed me up once.
Family.
Yep. We're not paying anything for a while.
Several weeks.
So investing is kind of, or having a property management. Yeah, I agree, fully agree, pay it yourself,
yourself, yeah.
auto pay.
Absolutely, you can't put anyone else in charge of this because it affects your entire financial future. And sometimes when, you know, even if it's that 12-month waiting period, that's something you can work with, but if there were 90-day late payments because you put some really bad credit repair company in charge, and we'll talk about that too. It can take years to get that score back up. Because there are some things that aren't easily fixed. So there are I just want to go into that right now while we're still on credit. Credit repair companies, this is something, please talk to your buyers about. Don't let them go find something on their own. There are some very bad companies online that take a monthly fee, and some of them are just slow, which is fine, unless you want a home, but there are some that they take a monthly fee and then they just dispute one little thing on one report once a month, and that goes on forever, which is not damaging, it's just slow. But we work with people who do a lot of just, you know, take care of everything all at once, as well as continuing to educate the buyer on what you need to do to qualify for a home, and we're constantly referring to the agent and the lender that referred them. So the two we work with do that. But there's a really, really bad one that some people find online that they actually recommend just stop paying everything, so that, you know, they'll just take a lump sum, a really small lump sum, or they'll just write it off, and it'll go off your report in 7 years, and then you'll never have to worry about paying this back. They market it kind of like getting around bankruptcy or something, which is technically true, that does happen, but what happens to your score?
Thanks.
It tanks for at least 7 to 10 years. And then how do you get a mortgage after that, right? So if your only bottom line is getting out of paying these companies, okay, but how much are you missing out on by waiting 7 to 10 years to buy a home? A lot more usually than writing off those credit cards that you didn't pay back. And then we'll talk about bankruptcy later on too. That's a whole different issue on credit. So any other questions about credit? It's a big one, so I think we go into that one a lot. Okay, so yes, back to Ian. What is collateral?
Collateral are things that you can utilize for money, potential money.
Yeah. So what would it be to get a mortgage? What would the collateral be for the mortgage?
It could be another property. It could be paintings.
Paintings
Yeah, if you have a
for the
price
down
on it,
payment, to source a down payment? Is that what you're referring to?
maybe.
Typically, the collateral for a mortgage is the house itself.
Yeah.
Right? So that's why the lender
I
is.
was going deeper. I was going too deep.
Like everybody understands that. But
So we're not necessarily, so that is why the lender requires the appraisal report, and will not lend more than the appraisal comes back at, because that is their collateral should the buyer default, and that's what they can sell the property for to get the money back that they loaned on that property. And then capacity. How about Ashley?
So just the ability to pay the mortgage, so if they have, debt to income, things like that, so if they.
You've been studying. Exact perfect answer. The ability to repay, and how we measure that is the debt to income ratio. Who knows what a debt to income ratio is? No, you've been doing this a long time.
Well, it's a percentage score of your debts and your income.
Right, so your monthly debts divided by the mortgage payment, and that's your debt to income ratio. And we'll have a slide later on the different debt to income ratios for the different programs. But it is, yes, a lot of the measurements that go into your ability to repay this loan. They don't have stated incomes anymore, stated income loans like they did previous to 2008. Although in 2001, I did get a stated income loan. I was a stay-at-home mom, and my husband at the time was self-employed. And as you know, people who are self-employed write everything off and don't show any income. And we were one of those that got it. We just went in there and said, yeah, this is what we make. And they let us build a brand new home out of that. So those things don't happen anymore because as we all know, everything crashed and tumbled and that wasn't a good system. So now lenders have a lot of guidelines and regulations that we have to piece through in order to prove that the buyer has the capacity, the ability to repay. And then that goes right into the next one. Jeff, I'll let you talk about compliance. What do you know about compliance in regards to mortgages?
Compliance, is that like, Fannie Mae, Freddie Mac compliances, the rules and regulations that you have to follow, adhere to actually qualify for the loan, is that?
Yeah.
What compliance?
Yeah, basically. So it's not just following the ability to repay the debt to income, not just following the minimum credit scores for each program, but there are other compliance issues that your lender should be educating you and your buyer on. So things like particular education around cosigners or what's called straw buyers. Like sometimes people will try to get one in one person's name, but it's actually for somebody else's name or using somebody else's social security number or things like that. So those are compliance issues that, again, you want to make sure you're working with a very well qualified team. So none of that comes back to haunt you later. As the real estate agent, you're not really going to have a hit if the buyers are out of compliance personally, but professionally, it's your reputation or on the line if you referred that lender. Now, if they just found one on their own and that happened, you can be a support team for them, but that's why it's nice to present a good team. You can say, I don't know this person, I've never worked with them. You might as well just get a second quote from this person because I know that they do a good job. I know that they do a full pre-approval. I know that they follow compliance. And if they still want to use the person you haven't worked with before, of course, the buyer is always right. But that is something I do recommend because agent, lender, title, any of it, insurance, can make a really big mess that hurts them financially for a lot of years.
It sounds like that's more fraud related.
Yes, yeah, that's the term.
Word, yeah.
Mortgage fraud. So we want to be in compliance and not worrying about those things. So you want to work with someone who is always studying and staying up to date on those. That's why our team, when we teach these CE classes and we go and we can offer the code of ethics and the mandatory residential, because we spend 2 entire days at the division of real estate getting all of the current updates on the regulations and the guidelines so that we can teach those classes. But also I'm like, why wouldn't every lender be here? Because you need to know these things. That is your job, to know these things. Okay, next slide here, residential lending, which is different than commercial. And here's screen share.
It's a really pretty painting.
That is pretty. It's not showing up.
What did you say this next segment is gonna be?
On the difference between residential and commercial lending. Oh, there it is. That one or this.
Should say screen 2 on it. Hold on, guys, let me figure out why I lost screen share. I think I need to put in presenter mode again. Or connect to the display.
Please find out if you can consume it, because if not, I'll talk longer, but no one wants to hear me for 2 whole hours.
He hasn't confirmed yet.
Okay,
Yeah, we should be back.
that's super weird that it just
Yeah.
goes out like that. Oh, there we go. Wait,
Oh, I just gotta share it now. We can see it, but I don't think we can. There's no-
friendly faces on Zoom.
Sorry, guys, I'm not really fast at anything.
You're forgiven.
Share
I'm
screen
gonna start
2.
calling people on Zoom. If you guys would be ready to unmute,
Can you see it
I
here?
think I called on everyone in the room are already. So the difference between residential lending and commercial, some of them are more obvious than others, but some are not. So residential zones, obviously single family homes, that is what we usually lend on, but there's a huge boom, which I think the trend is going to continue to boom in condos and townhomes for quite some time. only because our cost of living has gone up so much more substantially than wages have, and that will take several years to catch up. And so I think we're seeing a lot of developers going with condos and townhomes, and then multifamily units as well. So anything 2 to 4 on those can qualify for residential lending. Anything more than 4 units is going to lead into the commercial lending.
Is there a reason why 3 units is not?
What's up to?
Yes,
4?
up to 4.
Okay, so you can go up to 4 in residential.
Yes. So it
And
can be
anything after 4 becomes.
anything above 4 units then is commercial territory.
Okay.
So, and that's really nice. That's one of the hacks we teach in our investment class is to have, because you can get an FHA loan on, you know, a 2 to 4 unit property for as little as 3% down. And then you can start getting into and having the mortgages covered by the other renters. That's one of the best ways to begin real estate investing, because you can get a residential loan and which has the lowest rates and fees and only 3.5% down. But it does depend on the monthly payment, what everyone can handle, and there's details on
Does
that.
FHA allow them to use the feature rents as qualifying, or do they have to qualify on their own without? The
They
rents?
do, that's the point, yeah, is that they can get, if they can get they do have to get the contracts before closing. So, and if the rents will cover and fit into the DTI, then it works that really nicely.
What if you're like, you have a tangent, right?
I like tangents.
What if you get a 4-plex, it's all rented out, and you're gonna buy it with FHA loan, but then one of the tenants is moving out, so you can move in.
Yes, you have to.
And then those tenants are all like, hey, we're out when you buy this, we don't wanna be here anymore. We like the old landlord better,
You really don't like your pictures.
If you can get a
Right.
new contract.
So I can't utilize the past to show that that's what I can get. Okay,
They have to,
FHA is going, hey,
we have.
we
they
have
need
to
a
have the
12 month.
contract. So if their contracts go through your listing, you still have a contract and you can utilize it.
Yeah,
But if they're moving out,
You need a new one.
you need to.
and if they're less than 12 months, we will have to get an underwriter approval.
What if their contract ends and they're going month to month based on their old
Yeah,
contract?
that's what, we'd have to get an underwriter approval on that. one.
Okay,
So even if it's a 12-month contract, if it expires anything less than 12 months from the date of close.
the best way to do that is just, hey, you know
Just
what,
have
I'm
it
gonna make a buyer, if you wanna live here, sign it.
Yeah, exactly. And anything, you know, any detailed scenarios like that, we can have a chat anytime if you have detailed scenarios like that, but these are just general guidelines. Manufactured homes are different, they're challenging. They have to be after 1978 because the standards were not good enough before that. And they do have to be on a permanent foundation. Otherwise, it's commercial because it's like personal property, right? It's mobile like a car. If it doesn't include the land, it's not real estate. So, so those are things to be aware of that one. They'll have to go get a commercial loan, property loan, if it's a mobile home that's not attached.
Here's a question, so I've worked with 2 people trying to get mobile homes and we always end up going to like. Different
Yeah.
lender, but if the property is attached, that's what I would say is like, that's the one we really want, so you own the property.
Yes,
Um,
it's so much
what
better
if-
for them.
But if it's just the property and the home hasn't been attached to it, the property itself, does that count? Like, will you think it a loan for
So
both?
land without the home attached on it is also commercial. It has to have a home on the land to be a resident. Because you have to be able to live there. That's what makes it residential,
But it has to be like permanently attached.
permanently
So-
attached.
At the
Every
time of the
foundation,
loan.
at the time of the loan, unless you're
What-
doing.
What makes it permanently attached in those kind of things, like just connecting black pipe, you know? black
Putting
water,
foundation,
Putting foundation?
no
Voice.
wheels, no axles.
Voice of experience. okay.
Yeah.
Okay,
What if the wheels
Yeah.
don't touch the ground?
Now you can, there are
Oh, it's
construction
just
loans where you could buy the land and then put a modular on there. That's it. Like there's construction loans for residential that will include all of that. They're tricky to do, but we can do those under residential.
Right.
But it's gonna have to be permanently attached.
So if you have somebody selling the modular home and they own the land behind it, it's on
Yes.
wheels still. And then say, hey, if you want to sell it and make it a little bit easier, why don't we just go put a small foundation under
You
it?
would want to just negotiate that would be a condition prior to closing, but that would be done
Yeah,
during
that can be
your
done.
contract periods.
If you want to.
Yeah, for a listing point of view.
If they're gonna get more buyer appeal if it's, they
If they can do that,
prior.
they
to-
can qualify for a residential if they're willing and able to do that. So then, what is commercial territory would be large farms. So there is a tipping point in the acreage. 2, 3, 5 acres is typically fine unless the underwriter and the appraiser, appraisal comes back and there's commercial farms around it. Then they may flag it. So that's one of those tricky ones that we'll have to look at and be watching our F&A deadlines, because that's something we can't verify ahead of time. But we always order the appraisals to come back quickly, so that we would know those things. Again, I just mentioned this land or lots that don't have a home on it. It's not residential. You can't pop up a tent and get a residential mortgage for land. Anything over 4 units we already covered. Manufactured homes before 78 will not qualify, and like I already mentioned, mobile homes will not work. Okay, condos and townhomes. These are fun. They have their own set of guidelines, especially where it comes to HOA, specifically condos. They have a whole separate thing we have to get called a condo cert, making sure that there's enough funding in the HOA, that things are run well. They have enough reserves in there to cover problems, like roof or, the outside or crumbling parking lots. There's expensive problems that can happen that can make it, if the HOA doesn't have enough reserves to take care of those things, then no one's going to want to buy that unit if the buyer defaults. So those are things lenders.
Is there an actual guideline on the amount of research?
It depends on the property. So they're looking at that,
Like a percentage of the
it's a
annual?
percentage of annual assessments, and then it depends on, they also qualify it with, how many are owner occupied and how many are rented out. And then there's different guidelines for the different, products on that. So like, there's an equation, yeah, and it's pretty deep, and that is what the underwriter does.
And the things. No, I'm reading. Go ahead.
Okay,
Sorry, we have
So-
a question on Zoom.
Yeah.
It's going back to the previous slide. Amy, is wondering how hard is it to qualify for a mobile home?
if it is attached to the land, then we would instantly, send the appraiser out there right away to make sure that will qualify, and then it's just like a normal single family from that point in time.
Amy, if it's just the mobile home, it's a personal loan, it's personal property, you literally close it at the DMV.
Yeah, that's true, like a car loan,
You know,
yeah.
Well, I've had a couple clients that contacted me and they can only qualify for mobile homes. So I'm thinking, gosh, I wonder if I should send them away. They're like 100,000. Are they going to run into difficulties? I don't imagine their credit is stellar.
Yeah, they would have to go get a personal loan, like a car loan, at a traditional bank or credit union. And then they would also have to qualify for the payment on the 100,000 plus the lot rent if they didn't own the land.
Oh, good to know.
And yeah, and interest rates are higher, which is why we do recommend getting actual real estate, because a mobile home is going to be a much more expensive loan and it's a depreciating asset. They're not going to be gaining equity and appreciation like you would if it was a manufactured home on real estate, which doesn't appreciate as much as a single family home, a condo, or a townhome. But if that's all they can qualify for, and they need somewhere to live, that might be a viable option for them. So, but that's a whole different, that's not even in this realm, and I don't even do those loans. So I actually have referral partners that I would send your buyers to for those.
Okay, thank you. That's helpful.
Huh?
I said, thank you. That's helpful.
Oh, good. Okay. And you're free to call me anytime. When I have things that are outside of my realm, I do exactly what you guys are doing. I get a general knowledge, and then I have a referral partner that I have vetted out that knows what they're doing and, is constantly studying and educating people. So I'll have someone for mobile homes that I refer to. I'll have someone We do offer 1031 exchanges, and I even teach that class in generals, but for specific detailed hard questions, I have a referral partner for that. So I do what you guys are doing with this as well. So that's what you're gonna wanna have if you're dealing with some buyers like that, if that's in your SOI. Get a team together that can help you answer those questions specifically for what your SOI is looking at.
Amy, I have just a suggestion on that. This class is on loan pre-approval, right? I mean, just go through the application process, because somebody like Debbie might have conversations with them about getting a co-signer or other options to where they could actually afford real estate instead of a mobile home, because they only know what they know.
Yes,
Yeah,
thank
no,
you.
that's
I did want to mention that too, because that is going to be better for them with their long-term financial future. And so if there is any possible way to qualify for actual real estate, we're going to want to have that interview with them and discover all of the possible ways they could at least maybe get into a condo or a townhome or something like that to start. And then of course, we'll talk to them about, I always like to give people a 10-year trajectory of options. So if they're starting in a condo or a townhome, but they don't want to live there forever, then we'll instantly talk about how soon and what you can do to turn that into a rental and to get a HELOC and then to buy your home and what you need to do to get there. We'll give them all, I mean, that's the education piece, right? And that's our job as their trusted financial advisors for real estate in their lives. If they don't know, they weren't taught this in high school. So I feel very strongly about educating and teaching them all of those options, because they don't know what they don't know. So they don't even know what questions to ask. So thanks for interjecting that, Jeff. Okay, so FHA on condos, that one can be tricky. So the condo cert is going to come back and make sure that at least 10% of the units, no more than 10% of the units can be FHA insured. For fewer than 10 units, then it's only 2 can have FHA loans. So that one is a little bit tricky, but again, we're ordering that cert to come back as soon as possible. But that's one of the things that is out of our hands. It depends on how well the HOA manages the property, and it can be very telling. So our appraisals, although appraisers are technically third party and technically out of our hands, where I'm at, we actually have our own AMC in-house. And so we work with people we know that will get back to us quickly and efficiently. HOA certifications are way outside of our hands, but if they're sloppy, if they're behind, if they're not getting back to us timely, that's actually an indicator of how it would be living there. And so actually recently, Lynn and I dealt with this with somebody, the HOA, so they have to renew this, at this bottom one here, you'll see every 3 years, the condo project must be recertified to ensure it still meets requirements. A good and efficient HOA manager and team ought to know that and be on top of that. And there was one that we had a buyer under contract for, and it came back that their certification had expired. And it takes too much time to redo it. And also the buyer decided that was indicative of them not being a well-managed HOA, so she withdrew her contract. But if they get back to us quickly, efficiently, everything looks great, then you're looking like this property has a good HOA and it's probably a good investment. Okay, initial conversation. So this is how the whole pre-approval process and the whole home buying process starts. For anyone who needs a mortgage, a client will decide they want to buy it. Now, how that happens is different, right? Some people might be just chatting on their home, or they're just dreaming over websites, realtor.com or whatever it is, or perhaps Kitty knocked on their door and just let them know that this is what homes in your neighborhood are selling for. I just did an open house down the street and this is what it's sold for. Would you like to know? So sometimes you guys are sparking the education or the classes or the conversations just with your neighbors at a neighborhood barbecue or with your Uber driver on the way back from the Salt Lake City airport like I did. That sparks the idea for them to get ready to buy. So sometimes they're deciding on their own. A lot of times it's because the real estate agent that's in their life, if you're doing a good job staying in constant contact with them, you're sparking those ideas for them and with them. So at some point in time, they decide if they're ready. And usually they do talk to the real estate agent first, because you're the one that can show them the homes and the properties and that have all of those, you know, the market updates and the statistics, and they know that, and that's the fun part. And then, you know, the financing behind it is something people just think about like as the necessary evil that they have to deal with later. And so they want to talk to the real estate agent. You guys are the fun person, you know, the person that gets to show them the properties and drive them around and really bond and engage with them. And usually you have a really strong relationship with them anyway, with client appreciation events or other things that you're doing. So most of the time they do talk to a real estate agent first. And then you guys, now this is where you guys determine what you do at this point in time, just before they get pre-approved with the lender. Some real estate agents ask that right from the get-go, and they think it's not worth my time until they talk to a lender and even see what they can do. Other ones, if it's a new person in their life, if it's a new lead, some of them want to build rapport and build that relationship by going ahead and showing them a couple of properties first. So that's up to you and your mentor and your broker, and how you guys have that arranged on how you deal with people you already have a relationship with versus new leads, and how you want to handle building that and getting that contract signed with you as their agent. But sometime relatively soon in the process, you do want to recommend that they talk with the lender and get pre-approved, because otherwise it's just a waste of your time. I know you don't ever think of it that way, Kitty. I know you really care about the clients, and you would drive them around for 6 months. You probably have on some, knowing how long you've been in the business, you probably have to, especially in 2021, right? That was happening a lot. But it's not about that. It's about their expectations, right? We don't want to be showing them homes in the $600,000, $700,000 range. If they end up actually qualifying in the $400,000 range, then they're disappointed and frustrated. So it wasn't just a waste of time, but it actually can do more damage and harm in keeping them motivated and excited to build. And so it's okay if all you can qualify for is a condo right now, because here's what your appreciation will look like over time, and here's what you'll be building towards, versus waiting and renting. You'll be this much further behind. So you'll have those numbers and you'll have those conversations with them, and to help them get excited to get their pre-approval done. And something that we offer is because it's some people are already very motivated, and they will get their app and their docs in 24 hours, and we can get that to you in 24 hours. And sometimes it's not that way. And sometimes they say they're excited and they say they want to, and 2 weeks later, we still don't have the app, or we get the app the next day, but we still don't have the docs, or we're missing one piece. And to do the full pre-approval and really give you a qualified, rock solid pre-approval letter, we want it all. And so something we've recently decided to help motivate people is if they will give us everything that we've asked for, which isn't much. And we have a slide on that, but it's only 4 things. From application to documents submitted in 24 hours, I will personally pay for their appraisal to reward them for getting things done in a timely manner. Because, you know, we want to take care of them. We want to help them, but it can be frustrating for everybody when they have done part of the process and not all of the process, and it's been 2 weeks, and suddenly they call you and want to go see this home that just popped up on their market, and you're thinking, well, did you get your pre-approval done? What's going on with this? So if they will get that done in 24 hours, I will pay for their appraisal for them to reward them for that. But aside from that, asking them, having that conversation, have you been pre-approved? Here's why. We don't really want to, it's fun to go look at properties, but really we want to hone in on what you and your family qualify for. And there's only one way to find out, is to start working with your lender right away. And then again, we have this in here where a realtor recommends lender, because there's just like there's bad agents and there's bad title people, there are really bad lenders out there, and any one of those pieces can kill the deal and cause a lot of financial damage to this person. So I do recommend that you guys have at least one that you know and like and trust, that communicates with you, that does a very thorough pre-approval, and we'll go over some questions you can ask them to make sure. So, and you'll have answers too when they say again, oh, I'll just go to my bank, I'll just go to my credit union. That could be fine. That could be something that works out for them, but you might as well get an opinion, because there are bad ones at banks and credit unions too. And sometimes they're great, and sometimes they don't offer enough options, and sometimes they're bad too. So give them options and have recommendations, and you will come across as even more credible to them, and they'll trust you even more. So now that they have their lender, the process begins, the pre-approval process begins. So usually these days it's over a phone call. I do have some people who wait to make appointment until they can actually come into my office. And I'm sure that happens frequently in any, with any lender, with any mortgage company. I mean, occasionally, but mostly we're just having a phone call to start. We're getting an idea, and I'm going to go over a lot of the questions that we ask on the next slide, but we start basically our interview process, just like you guys did. An interview process about their goals for homeownership, their long-term goals, different qualification factors, and we're taking very careful notes because not everything shows up on the application itself that we need to know. So we're writing all of those pieces of information down. And as soon as we have a general picture of who they are, what their circumstances, what their long-term goals are, then we send them the application to fill out. It takes about 15 minutes. We let them know what's going to be on there so they can prepare things ahead of time. Your employment history, your residential history. We're talking about them. If they don't have the 2-year history, I'll talk to them about that, and that's on another slide. And then we give them the list of the paperwork that is needed. Now, the standard is the driver's license, copy of driver's license, last 2 W-2s, last 2 pay stubs, and last 2 bank statements. But if during the interview, other things came up, like they're divorced, we'll be asking if they have any alimony or income that they want to use to qualify, because we can count that as income if we can show they'll get it for at least 3 more years. So then that will be included in that email in the list of documents. Or if they're self-employed, they obviously don't have pay stubs and W-2s. So we'll be asking for the last 2 years of tax returns. If it's an investor, we'll be, we're asking those questions too. So if it's an investor who wants to, turn this one into their rental and purchase a new one and have the new one be their primary, then we're going to need the mortgage statement. So we have the payoff amount. So things like that. So we have the standard 4 docs, and then, but in the interview, if we know that it's a different circumstance, we're asking for different docs. And then once they filled that out, yeah.
Can you repeat those standard 4 again? I got
Yes.
3 of them.
Copy of driver's license, last 2 W-2s,
Mhm.
last 2 pay stubs, and last 2 bank statements. Bank statements is to source down payment funds and things like that. Also, the underwriter will be looking for large deposits that are unexplained because they don't, things don't show up on a credit report for 30 to 60 days.
Mhm.
So they need to verify that there was no new loans taken out and things like that. So there's a few reasons why we need the last 2 months of bank statements. And then from the time of the pre-approval to time of contract and closing, if it has been a while, they will need to get those updated. And then we're calculating, so once we have those documents in the application, we're looking at those pay stubs, we're looking at, are they salary? That's really fast and easy. If they're not, if they're hourly, and then we can consistently show 40 hours a week, that's the second easiest. If their income varies from week to week, it's called variable income. And then often we will need to ask for additional pay stubs to be able to balance that out to get the most bang for the buck, the highest purchasing power. We'll ask usually for the last pay stub from the end of last year so that we can balance that out and get an average. And then of course, self-employment taxes. This is where we do a full-on strategy session with them because it is the most complicated. So if it's right before they've submitted, then we're going to actually work with their CPA and give some recommendations to maybe defer some of the write-offs or things like that to show more income so that they can qualify for more. Because if you can go through a traditional conventional or FHA loan, they'll have the lowest down payment and the best interest rates. Now, if they've written everything off and that's already done, and they don't show enough to qualify, we do have other products that we can look at. So this is where we're having this whole financial forensics conversation, right? We've got DSCR loans, bank statement loans, but they usually require 20% down and sometimes more depending on the credit score.
Oh, I was just gonna say, I have a gal I was gonna start working with, but she works from home and she does all writes off everything for her
Yep.
company and shows that she made very little last year. So now she's gonna claim everything.
And work towards.
Yeah.
So for the next year, she's going to
Yeah,
not do the write-off so she can try to get traditional financing. Yeah, so I just did a bank statement loan and, yeah, it was, and also he had a really low credit score, so it was almost 10% interest, but he still felt like it was worth it. Because he really wanted to buy this condo and start owning instead of renting, and he can actually refinance in as little as 7 months. He just hadn't done his tax returns for the last 2 years, which is why we went. That was one of the rescue deals. I don't know how he got a pre-approval from an online lender without having done his tax returns for the last 2 years, but he was already under contract and he had already gotten past F&A, so his earnest money was already on the line. I'm like, well, you can decide. This is your options. You can, pull out of this and wait until your tax returns are done and get traditional financing, or we can do bank statement options. Your score is also low, and so it's going to be a 10% interest rate. Do you want that? That's the best that we can do. And he wanted it. So we moved forward with that, and he'll just get his tax returns done and then refinance in 7 months. So that's fun. But there's always a lot of options. And again, it just depends on, they just need to be educated on what those options are. And then they feel like they have the power to make their own informed decisions instead of, just somebody telling them, this is what you want. Like with the mobile homes, right? They may think that's all they can do. And so unless their team is educating them, okay, yeah, that's what you can do right now, but here's what else you could do, and here's the steps to get there. They might decide to work towards that if we take the time to educate them. So once we have all that big picture in mind, all the ins and outs of all those different pieces, we've got their DTI, we've got their income dialed in, then we talk about, well, here's the loan programs that you can qualify for, and here's the different options within each one of those. So sometimes people have a large down payment, and we don't just say, well, here's where you're at with that. We say, here's where you're at with it as it is, but there's this option too. If you want reserves in order to be able to build an ADU or to upgrade your flooring or things like that, or to just, if it's a first time home buyer, we're going to recommend reserves simply because they're not used to taking care of their own things that can go wrong. But if they don't have a down payment, or if we're at a 0 down program, that's just not an option, right? Here's Utah Housing. Here's what you can do. Do you want it? So we're going to go through all of that and all of their options. And then, so here's some of the questions that are also in that email. So they've got the link to the application. They've got a list of the documents that we're going to require. And then I also have them just go ahead and answer these basic ones right up front as well. So I know a direction of what other questions to ask. So let's get some audience engagement here. Why do you think, Brian, I would ask them where they're looking to buy?
Are you asking me?
Yeah.
Well, that's an obvious question, just so you can kind of know, like, you're not pulling things from the whole state trying to figure out where they want to buy a house.
So for real estate agents, that's an obvious question, but why would your mortgage loan officer need to know where they're looking to buy?
Well, I think there's also each county has like minimums for like first time home buyer programs, and also what FHA, what the max loans are available for FHA, and I think conventional as well have those same limits, but doesn't it depend on your zip code or your kind of area? Like I know Summit County has larger jumbo loan type restrictions because the houses are much bigger up there, and like Weaver County is different than Salt Lake County and that kind of thing.
Perfect.
There's also USDA loans and grant programs specific.
Exactly. So those are the three answers. Basically, the conforming loan limits, the grant programs are usually city specific, except with the $20,000 one that's coming up in July. That is statewide. Grant programs are usually city specific. Conforming loan limits, like you both mentioned, are different per county. And then the last one is USDA, right? If they want to be out in rural areas, then we will look at if they qualify for a USDA loan, which is another 0 down program. So why am I asking them if they have military experience?
Is that a question for me too, again?
Anybody?
Want to see if they qualify for a VA loan.
VA loans are the best loans. So they are a true zero down, and they also have really good interest rates and also have no cap on DTI. So as long as they can make the payments, we've seen them go as high as 60% on DTI. If they're comfortable with that, and that's another conversation we're having. So you could qualify for this amount, but here is your monthly payment. Do you want to do that? So it is the easiest loan, the best loan for people to do. They can sometimes take a little bit longer because we have to order the appraisal through the VA financing, and there's a little bit. So we're not going to do like our 10-day close on VA, but they are a really great loan. It's really good option if people have military experience. Yeah.
Military and law enforcement are considered the same?
No, law enforcement does not qualify for a VA loan. It is military only. And they do have to have, there's certain, they have to have qualifications for how long they have been serving. And so what we pull, that would be the extra paperwork that I would ask for in their pre-approval email is called the DT 210, right? No, my TM does it for me. Because she gets the paperwork and submits that for us. 14, thank you. Thank you. Do you have military?
Yeah.
Okay. Do you have your papers?
I do not.
Ah, all right. So
I
she.
found weird papers. They screwed my, you know.
Oh, and that's
That's the
not
good
good.
one.
So they have some paperwork that shows that how much service they've done that we submit to the underwriter ahead of time to see if they can qualify for the VA loan on that. And then we're looking at their timeframes for.
With the police officer thing, isn't that why you would ask where you're looking for? Because some cities will have.
Police grants, Homes for Heroes and things like that, yes. Yeah, and so that's why we're asking all of these questions, to see all of the loan products that they could qualify for so that they can choose and they can decide.
How about
Time
retired,
frames?
how about retired law enforcement?
Sorry, what?
How about retired law enforcement?
Yeah, retired law enforcement would also qualify depending on the grant. So the grant, you know, whoever is issuing that, those are the ones that will have the qualifying factors attached to that grant. That doesn't go through the lender. The lender has to apply for the grant for your buyer, but they have their own set of guidelines. So we have to look at all of those individually.
Okay, thank you.
You're welcome. And then we're asking them what their budget is, what monthly payment they are comfortable in. Because just because they can qualify for 600 doesn't mean they're comfortable with the monthly payment and the cost of living that's going to stretch them to. In our industry, it's known as payment shock. And so we do actually, in the application, we have what their current either monthly mortgage or monthly rental payment is. And if it's substantially lower than the new one, that is actually a red flag for underwriting, because if they have what they refer to as payment shock, it's a potential default red flag. You're super early. Amazing. Okay, so we'll be looking at that and having those conversations with them as well. And then how much do you have for down payment and what do you want to stay under? So like last night, I just had this conversation with someone. She has $20,000, but she says, but I'd like to look at the zero down programs anyway, because she wants to keep some reserves. So my job now is to show her what she can qualify for if she uses the down payment fund and what she can qualify for if she applies for the zero down programs. Because again, lack of education. Most buyers do not understand that the down payment of the zero down programs, except for this new $20,000 one from the state of Utah, that one is interest free and payment free, but Utah housing has a much higher interest rate, which will drastically reduce what the purchase price is. So I will show them that it does that, right? I'll show them the rate difference and the price point difference and then the monthly payment difference. And then most of the time, people do choose to access their down payment funds because it's such a better option. But if they don't have a down payment, we'll be very encouraging and very motivating anyway, saying, but that's okay, because even though to start, it's a higher risk loan, so it's a slightly higher interest rate, slightly higher PMI. It's still better than renting, because renting is 100%. And so we will show them, the cost of waiting and just encourage them, even though the rates seem a little high compared to what we were used to the last 2 or 3 years. It's still usually better to get in sooner rather than later if you consider this, a long term. This is where you're going to live. If you're going to be there 3 to 5 years, it's still going to be worth it. And then as soon as you hit that point where your loan to value is 80%, you can refinance and get into a conventional loan and have a much lower interest rate and reduce your monthly payments. So we'll be looking at all of those options with them if they want to see both of them. Then we're getting a history of bankruptcy and foreclosures right up front before we even pull their credit reports, because there's no need to. If they do have a recent bankruptcy, and I have another slide in a minute I'll get to with the wait times and the difference of 7 versus 13, but this is just the conversation we're having right up front. If they're just in the middle of filing and it hasn't been discharged yet, we don't even need to proceed at this point in time. I will let them know what they need to do, when they need to do it, how they need to do it before we touch base again. Same thing with foreclosures. So we're asking them those things ahead of time, so we don't even bother dinging their credit. It's actually only 4 to 6 points, a mortgage pull, and it recovers in 6 months or so. So it's not as much of a hit as people are worried about, but still, we don't want the hit on there if we can verify some of these things ahead of time for them. And then we're asking them about their work history and what their monthly income is before taxes, because that's what we use. And then if they don't have, a lot of people, there's an old misconception that people have to have 2 years of history at their current place of employment or in the same industry. That is no longer valid. We only need 2 years of employment history total. And if they have a 6-month or longer gap in employment, it doesn't start that 2-year history over again. They just have to have 6 months back on the job as long as there's 2 years of history total. So that makes it kind of nice.
So it's a collective 2 years.
Collective 2 years, correct. And then because, stay-at-home moms who get divorced and things like that, if they have 2 years of history, even 10 years ago, we can count that as long as they've been back on the job for 6 months.
Yeah, but they took 6 months off and they only been working a month, they would need to have 6.
Not necessarily. So if we can explain the gap, like maternity leave or something like that, then we can qualify them off of just their first pay stub back. So if it's really close to that 6-month gap, and we can explain it, we can get an underwriter to approve that. So it depends on the circumstance.
Okay.
But like a 10-year gap, they're going to need to be back on the job 6 months. And then, okay, again, we're looking for all of these pieces to find what different options they can qualify for, and then letting them choose. But we're always recommending, we'll let them know this will give you this will give you that, this will give you the best bang for the buck right now, this will give you the best bang for the buck long term, and let them have those conversations and let them make those empowered, educated decisions. So this is what we want them asking us. We're going to go over these questions with them if they're not asking them, but these are, if you want to, have this conversation with your buyers before you send them to your lender, go ahead and screenshot this, or I'll send you the slides, but tell them to ask their lender these questions about which loan programs are best and why. Because like I mentioned before, some people just say, hey, we've got this fancy new schmancy deal and that's the one you want. And I've gotten quotes from other places like that, and without looking at the whole picture, I told you this story before because I got the quote while I was walking in here, and by looking at his whole picture and not using that program but educating him on other programs that he did qualify for, we saved him $150,000 over the life of the loan, which he does plan on staying in the next at least 10 to 15 years. So it was really worth having that conversation, not just using the fancy schmancy, really great marketing one that was just slid in front of them, right? So you want your buyers to ask their lenders these questions. What is my credit score? They have a right to ask that. We can't give them our version that we pull, but we can give them a version with their scores on there. What credit score do I need to get the best deal? So again, we're going to tell them that's a great question. It depends on the loan product that you're looking at. So some people are like all focused on just the rates. It's not just about the rates, because when you guys get the Tuesday rates emails, and I get the phone call saying, why is FHA so much less than conventional? Why did you approve my buyer conventional if FHA is lower? Well, here's why, because the mortgage insurance on FHA is substantially higher. And so their monthly payment is high, it would be higher. It looks like the rate's lower, but their monthly payment would be a lot higher if we went FHA, because it's really meant for low income, low credit score buyers. And on top of that, the mortgage insurance never drops off on FHA. They would have to refinance to get that removed. On conventional, it will drop off at 80% LTV. And so we're happy to have those conversations with them. We have them right up front. But if you're working with someone and you're seeing that and you have those questions too, just making sure that lender is giving your buyer the best deal, call them up and ask those questions. Do not ever be afraid of asking your lender.
I can do it right now. I have her sign from Oak Street in my truck that I took out of there. Oh, look.
I don't know what he's talking about.
Oh, Brian, can you? Oh, thanks.
Sorry about that. Somebody just asked me a question. I apologize.
It's okay. And then talking about, like I mentioned before, the different down payment options and what is that going to do to their rates and their fees and their monthly payments. So what the zero down programs are going to get for them versus the 3% on conventional or 3.5 on FHA or the 5% conventional if they're not a first time home buyer. And then we will look at, sometimes people have the full 20% down, and we will, because that's everybody knows that's the magic number to reduce the PMI, but sometimes they want to talk about having reserves and the other things that they want to do with that, or use that money towards their first investment property. So we're going to have all of those conversations. We'll go over the fees, like how much underwriting is, how much the appraisal is, things that are non-negotiable versus the things that they can shop for. And then we will give them an estimate of the payment based on, I'm going to show you the next chart. So there's two different numbers we're looking at, what their max purchase price is, and then what they're comfortable with. So we're going to give them a payment sheet with their pre-approval letter of homes, different price points, like a few above that and a few below that, so that they don't have to call me and every $10,000 increments and say, what is this going to be? They will be able to have that. Of course, we'll fine tune it when if we get, you're saying, this is the one we want to put an offer on, and send me the listing, and I can look up the taxes and the HOA fee after that, and we can fine tune this a little bit. So this is an example of what we would send them. So, and I can't give this to you because we fine tune it each time. So rates fluctuate a little bit daily. So we'll put that average, what the rate is, what their down payment is, and the purchase price that they're looking at, usually somewhere in the middle. So if this person was looking at, wanting to stay at 350, but they could go to 450, this would be an example of something I would give them. And then the PMI, that's going to be very different for each person too, because it's based on their credit scores and their down payment amount. So that's something that you guys wouldn't be able to do. That's why I can't share this calculator with you, but it's just an example of what we send with them with the pre-approval letter. And then HOA, so all that they have to do, and we're willing to do a new calculator every time, but all they have to do is add the number that's in the listing. So if it's $50, if it's $120, they just add that to the estimated payment at the end. What are we at? Okay, 15 more minutes. Any questions so far on Zoom or in person? Pretty simple information. Okay,
I love that payment example sheet that you do. I have worked with a lender in the past where my buyers were right on the edge of approval, and they were calling the lender with every house. What will my payment be on this one? What about on this one? Like, come on, can't they give you something?
Yeah, and we're finding, if it is right on the edge and there is an HOA fee. And they need to see if they can put some of the closing costs into the loan to adjust the deed. We're happy to do that. I've done that at 11 o'clock at night, and I've done it at 6 a.m. on a Saturday morning. Because we're in it with you, right? The goal is to get them to their goal. We'll do that, but that is why I send that, so that they feel confident knowing basically where that's going to be at in those different ranges.
Thank you.
Of course. So here's the key pieces of information that are on the application. These are absolutely required. There is no getting around them. If you want a pre-approval and you want to get the loan, we have to know these things. We have to know their social security number because I have to pull their credit report. Phone number, marital status, making sure they type in their email address correctly, the one that they can access, because I had a buyer yesterday that she didn't know how to access the email address that she gave me. And that's what all the disclosures on the CD and the LEL go to that. And so that was fun, but we're going to be talking about that. And then if we have co-borrowers, we would love for them to have their own email addresses, because we need each of them to sign disclosures. We need each of them to download the appraisal reports. And so that gets tricky if they're using the same one, like many couples do. So I'm just going to let them know that right up front. When you're filling out the application, if you guys have a separate email, and make sure you can access it, because this is where all your docs are going to be going to. And again, covering, just like I already talked about, employment history and the varying factors for that. The same thing with residents. If they haven't been in their current home for 2 years, we'll just need them to fill out the section below, so we can show 2 years of history, because we're matching that up with the credit report, and matching that up with making sure they say they're a citizen and all of those pieces. I do not have the buyers fill out the debts section unless they just want a quote, just an estimate. Then they can, but usually I can take those numbers verbally, but it's not going to give them a very good idea. A lot of people really actually don't know their monthly minimums, and I can give them a good, decent estimate, but really, if they want to know exactly what they can qualify for, we do have to pull the credit report, because our requirements are the minimum monthly payments on all credit cards, car loans, and then student loans I'll talk about in a second. They're a little bit variable. But when they list their debts, I don't even talk about that on the phone call unless all they want is a quote. If they actually want to get pre-approved and know what they can buy, that will automatically populate into the liability section when we pull a credit report, so they don't even have to fill that out. We don't have to count utilities. We don't have to count cell phone bills, even if you have a 3-year contract. And then we are having this conversation about, so if they mark that they're divorced in the application, then I'm having the question, hey, do you have to pay? So, some of them we might be, do you want to use alimony or child support? If you do, and if you get it, and it will last more than 3 years, I will also need a copy of the divorce decree. If you have to pay it, we have to count the full amount, and we also need a copy of the divorce decree. Assets information, we don't need any of that unless it's something you're using or selling or getting a loan against to use as a down payment fund. So current property, if they're selling one, going to use that goes in the asset section. Other than that, usually nothing does. People like to put their cars in there. We don't need your cars in there unless you're going to sell it for a down payment. So let's see, what else? Any questions on that? I think I've already covered that. The credit report, pay stubs, trends, conversations. Oh, sourcing and seasoning. I think everyone's here knows. Does anyone not know what sourcing and seasoning is? So
Like oregano, thyme.
that's the good kind of seasoning.
Depends on what you're making.
Depends on what you're making. If you're making a mortgage, seasoning is showing that it's been there for 2 months. That's why we get the 2 months of bank statements. Sourcing is showing where it has come from. So if a new large deposit shows up in the bank account, that is a red flag for the underwriter, and you have to source it. If it's been there longer than 2 months, we don't have to source it. That has been seasoned. So large chunks of cash from underneath the mattress. Yes, I have encountered this. We can't use that. You will have to wait for 2 months. However, I had a borrower who He was self-employed, so he didn't show as much as he knew he wanted to qualify for and could afford. On his tax returns, and he was very frustrated about that. And did not want to look at the non-QM lines. So what he did was he took a couple of months selling exotic puppies, and him and his daughter came up with $80,000 in puppy sales. And because they had the paper trail on each one of them, my underwriter was able to source all of those, and we were able to use that. So he had a very large down payment, which obviously increased his purchasing power and got him to his goal. Yeah, so, and that's
Exotic puppies.
exotic puppies. I can't remember which kind they were, but she had to source every single puppy sale on the full $80,000. But we did it. So that's a fun one. I like to have, that's another thing I'm having conversations with people about, because sometimes people will take up a second job or a side hustle or something so that they can qualify for more. And then that doesn't actually count. There has to also be a 2-year history on a second income. You can't just go get a waitressing job nights and weekends and suddenly count that. So, but it can work towards the down payment. So I'll let them know, you know, I can't count that against your DTI for 2 more years, but let's not wait 2 years. Let's see what we can do to maximize your side hustle towards your down payment and reduce, you know, gain a larger purchase price that way. And I'm a very creative person too, so I like to talk to them about what side hustles could actually get them a little bit more than their current one as well. So if that's the goal they're working on, that's something I will brainstorm with them. It's fun for me. I like to help people get into their home. I think I told you, like my Uber driver, like he already owns a home, but he wants to invest. I spent, you know, from Salt Lake to my car talking about real estate investing. So excited and so driven by that conversation that he's been doing everything we said ever since. He's stopped doing Uber driving full time. So because he's not showing enough income, he went and got a W-2 job that was salaried, and he's doing the things to get his goal, right? Because we're willing to give him a plan of action and he's willing to work towards it. Underwriting. Okay, this is what you want to know. Whether you're working with a lender for your buyer, or if you're calling on an offer and you're the listing agent, you want to ask, what kind of pre-approval is this? Have you verified the documents that I just told you about? Have you looked at their W-2s and their pay stubs and their bank statements? This is not out of compliance. You have a right to ask those questions, and you ought to. And then you want to ask this as well. Have you ran them through AUS, which is an automated underwriting system? Because there are these variable factors, right? So like say they have a couple of missed payments, but their score is high enough to qualify under the guidelines, that doesn't mean that it will. Sometimes that works and sometimes it doesn't. And the only way that you're going to know is if you run it through AUS. If you get an AUS approval, it's a pretty rock solid buyer. So you want to make sure that they're doing all of that and that you're not ending up with a buyer, you know, a rescue deal like I just did. They not only weren't ran through AUS, no documents were verified. It was all verbal, and he did not qualify and almost lost his earnest money because of it. So we don't want that happening. And this is where you're their teammate on this. You're their mentor, you're their guide, you're their guru. And so don't feel bad stepping up and asking if it's a lender you haven't worked with before, or even if you have. I get hard questions asked to me, even though I've got a tight 2-year relationship with someone. They're like, hey, wait, why did this happen? And I'm happy to have those conversations, and we ought to. Okay, so then address. This is something that we are verifying. This is a tricky thing that gives some hangups too. There are some areas that come up different in underwriting than they do the buyer put on their mailing address. So we know those areas, and so we're verifying that, and that's also something that can be triggered by AUS ahead of time. So we don't have to wait till those weird things come up in underwriting and potentially causing a delay. Appraisals, knowing when those are ordered. So for us, as soon as the buyer is in setup, as soon as they have locked in their loan, we order it immediately, same day. Because you want that back well ahead of your FNA deadline, because you can't even submit to underwriting So the appraisal's back, unless you do some pre-underwriting. And so there are some reasons why you would want to. And we're willing to work around and do that if we need to. But traditionally, you need all of these documents. There will be a few extras that the transaction manager and processor ask for once the loan is started. And then you want appraisal back in enough time to get in and out of underwriting before F&A. And then we're looking at if there's any collections or judgments, derogatories. We're going to be having conversations about that. They may or may not pass. And then we're going to be making recommendations, right? If something like that shows up on there, some buyers think, oh, I'll just dispute it and it'll be fine. It's not fine. You cannot get a loan while anything is under dispute because the underwriter can't verify how the outcome is going to be. Just like you cannot get a mortgage while you're going through a divorce. It is a lawsuit and the underwriter cannot verify what the outcome will be. What is the judge going to order you to pay or not pay for alimony or child support? We do not know that. You cannot get a mortgage while you are in the middle of the divorce process. So this is another, thing keep in your head. If you run into buyers who are thinking about getting a divorce, you may want to have a conversation with them about potentially selling and buying before they even file. It might put them in a better position financially. That's something we want to talk to with them. Calculating income. Yeah, we got 3 minutes left. Basically, I kind of already covered this, right? You can't use a second job tips and side hustles and things like that unless they've had the second income for 2 years. And then, this is interesting. So I had one, she had her standard main job for several years, but her side hustle she had for 6 months and it was making her more money. So we actually counted that as her main income and didn't count the other income. And we were able to do that because it qualified under the 2-year guidelines, right? So these are the questions we're asking and diving in deep to figure out the best possible scenario for everybody.
Can I ask a question about that?
Yes, of course.
What if all of your income is side hustle, like you're a 1099, but you have 3 or 4 things that you're bringing in income from? Then it's obviously different.
So each thing has to have it. So we'll have whichever one has the most income, we will have as our main qualifiable income. And then anything off of that has to have a 2-year history to count. But you can count as many as you want. Many of my entrepreneur friends are multipreneurs and have 4 or 5 businesses. I have one friend that owns 17 crumbles and 20 swigs back east, along with a couple of businesses here. That happens when you get into investing and entrepreneurship. But so we have to have a 2-year history on each one of those in order to count that. Okay, student loans I do want to talk about, and then I think we'll just kind of go through really quick, see if there's questions, and then we'll get to our amazing sponsor because he's way more fun than I am to listen to. Everyone knows this is true. Student loans. So this is a conversation that I have a lot because people think if it's in deferment, they don't have a minimum payment, so we don't have to count that. We do. Even if they're in deferment, even if it's for 3 years or more, that guideline doesn't count for student loans. So for Fannie Mae, we have to use 1% of the student loan as the minimum monthly. For Freddie Mac, it's 0.5%. So we almost always go Freddie Mac if someone has student loans, unless they have a very, very large income. So that's something to be aware of. Screenshot this. These are your wait times for bankruptcy. I'll just cover that really fast. If they're in 13, that's the reorganization, that's the monthly payments. There is only one unicorn product that will potentially allow someone still in 13 to qualify if their credit score is high enough, but we've never seen it happen. I mean, this company that I'm at right now has been open over 20 years and nobody's ever seen it happen, but it is something that we'll look at. Otherwise, they have to wait till discharge and then these wait times start. Now that being said, also everything we've almost always seen is people usually can't even make those payments because they couldn't make them to begin with. So they usually end up switching from 13 to a 7, which is the complete wipeout. And then these wait times start from the discharge of the 7. And so if their goal is to, get into a home or something, that might be something they want to consider, just switching to a 7 now. Because otherwise they're looking at these wait times starting after discharge on the 13th. And that's a really long time, but it depends on their goals and what they want and what they committed to, and it's a personal decision. So just be aware of that. Co-signers, everyone knows how that works. If not, you can call me later. Acceptable sources of down payment. Seasoned, more than 60 days in the bank account, proceeds from the sale of the current home. Obviously, we do that in conjunction all the time. It's called a domino sale. Loans against assets. So we can take, a HELOC from one property to buy the next property or things like that. Gift funds from a family member. They have to submit a letter stating that it will not be required for them to repay it. And then in addition to that, FHA will also require we see 2 months of the gifter's bank statements. And then gift of equity is a unique thing. It's tricky, but we can do that. Let's see. Here's the zero down programs. Call me if you have a question. AUS, I kind of already went over that. Mistakes. We had this happen recently too. It was also with Lynn. The person was self-employed and she told me in the interview that she owned the business. She also, didn't cover the box that said this is a family-owned business. And she told me she owned it, and she didn't click the box that family owned it, but it came up in underwriting that her parents owned it, not her. So it did cause a little bit of a bump, a little bit of a delay. We did still close on time, but it was one of those like, hey, why did this happen? Let's talk about it. How can we avoid this again in the future? Lynn was really nice about it, and she did understand that this was something that I did cover in the interview with her, but these things do happen. And so we're trying to be as thorough as we can in these interviews. But sometimes like people will think that they don't have to tell us that they're paying child support or something, or they don't mention that they're divorced or something like that. So they do have to in the application. So that's where then I go, if they didn't mention it in the interview, I'm looking at fine tooth comb through the application. Hey, if they're divorced, oh, is there a decree? What does it say? Oh, you have to pay child support. We're going to have to put that against your debt to income ratio. Other lawsuits, we don't get those in the application unless it's a foreclosure or a bankruptcy. So if they're in some sort of other lawsuit and they don't tell us about it, these are things, those are kinds of things that come up later in underwriting, which is why we want everything submitted well before FNA. Those are the kinds of things that we can't control if they're not telling us. We try to let them know that we're going to find out and we're going to discover everything. But occasionally those things do happen. New collections, things like that. If they're missing payments or going into collections or things like that, and they think, well, I already applied and my credit was good now. So for the next month, I just won't, so I'll have some more savings. Be surprised, that does happen. There is another soft pull then at the end. So we are letting them know, please continue to make all your payments. Do not get new lines of credit. All of those conversations are happening because there is going to be a check, soft pull, a check at the end, just to make sure nothing has changed in your financial circumstances. If it does, and if it gets pulled up, you may not qualify anymore. So we are having those conversations. Make sure that the lender you work with is having those conversations, and you guys reiterate this as well. All right, here is the code. So go ahead and fill that out really quick for credit today. And like I said, I'll get that banked either today or tomorrow. And we'll give you about 30 seconds to fill that out. And then I get to turn the time over to the rock star back here, Chad Ibex. I actually love working with Chad. They bring him to most of my things, and I've had several of my agents now say, hey, I really like that guy. I want to work with that guy. And so I consider him part of my team. Like we were talking about at the beginning, having people you know and like and trust who take care of your buyers. I consider Chad on my team because he takes care of the people that I put him in front of. So welcome, Chad.
My goodness, I need to take your memory class. That introduction was phenomenal. And I've got street tacos for all, but all you that are on this call, I wish I could ship them to you. I gotta be able to figure out how to do that. So thank you. I wanted to just take a minute and tell you what we have been working on at Ibex to make sure that we're taking care of your customers in the right way. So To us, we like to have fun with our marketing. It's crazy and fun, but on the service side, we're dead serious about it. It is something that we really work hard to make sure that people have a good experience when they come to Ibex Home Warranty. So let me just tell you a couple things that I think are really important. One is when somebody calls into our office, they are greeted in 15 seconds. That is something that is really important to us. We don't know. I don't know how many people like to wait on hold, although for 15 seconds you get to hear goat noises. It's kind of fun, right? And they put them back on hold because it's relaxing, right?
They are fun to listen to.
Well, thank you, Kitty. I appreciate that. That was not my voice. Somebody asked me the other day. I did not do the goat noises. The other thing that's super important to know is our commitment to making sure that your customers get taken care of very, very quickly. So 65% of our service calls are handled same business day. Now that's unique to Ibex because we employ our own contractors. And the reason why we do that is they don't have any third-party jobs. They are all committed to Ibex, which makes everything so much more important to them. They get out quickly, they handle things quickly, they do it in the manner that we want them to do it, which is efficiently, safe, make sure that we're doing the right things to take care of the customers. So keep those things in mind. The other thing that I'd mention is I think we have, I'm biased obviously, but I think we have tremendous coverage. So for $600, you get coverage for the AC, electrical, plumbing, all the kitchen appliances, washer, dryer, and garage door componentry, all completely covered. So just for the $75 service call fee for each transaction that they go out on, our service call fee, we'll take care of them. And that's about all I have today. So you guys have any questions home warranty wise? I put everybody to sleep. Okay. You were thinking about the tacos over there. Can you smell them? They smell good.
I have
Yes.
no questions. I just think Ibex is phenomenal and fabulous, and I wanted everybody to hear that.
Oh, pay for that. Was it the street tacos though?
That must be it.
No, I really appreciate that. I really truly do. Thank you for letting me be here today. I hope you enjoy your lunch. And for those online, I'm sorry I can't get you the tacos. But here's the last thing I'll leave you with. Like my friend Napoleon Dynamite says, do you guys know who he is?
Oh, yeah.
You do? You know who he is. Okay. What are you really? Are you from his hometown?
Not Preston, Idaho Falls, about an hour north.
Okay, that's why you're so awesome.
Right.
Yes, right. Borrowing his line a little bit, use Ibex Home Warranty and all your hopes and dreams will come true. I think he did that during his big speech. If I remember right.
I remember the same thing.
Do you remember it? All right, you guys are great. Thank you for letting me be here. Appreciate you all.
Thank you.
Dad.
Thank you for the.
I'll go back to this slide one more second in case any of you didn't get that QR code. Two takeaways, good talking points from the loan application thing is bring up the Credit Karma thing to people.
Yeah.
As far as their score might not be reflecting what they can actually accomplish if they were thinking about home buying. Maybe they're fence sitters because of misinformation, right? And then Ian brought up one, it's like pay more taxes to buy a house. You know, get those self-employed people to maybe not take as many write-offs so they can get into home ownership a little bit. Those are some good conversations to have, and then send them to Debbie for pre-approval, of course. So, hey, guys on Zoom, thanks so much for staying with us, and I wish you were here to network a little bit more. Maybe next time, come on in if you can fit in your schedule. I'm gonna let you guys go.
Thank
Thanks.
you. Thank you.
Thanks a lot, guys.
Per usual.